Hey folks, hope you guys are well today. Let's do a little Monday video. So today's video, I wanted to talk about something called a liquidity trap. Now this happens quite often. We're talking about markets here, supply and demand and order flow trading. So essentially, what is a liquidity trap? I want to talk to you about this. Now, generally that's just kind of what I call it, but there could be another name for it. Also, it's not really a term that is set in stone in any book or anything. It's just sort of a concept that I want to describe to you in this video. So I want you to imagine the majority of traders looking at the same, support and resistance levels, I guess. And imagine our market professionals who, have their agenda as to whether they need to be buyers or sellers, and if they want the market higher or lower in the grander perspective of things. So in this video, I'll share with you a couple of things I've noticed. Now, number one, traditional candlestick patterns are failing a lot these days. So it's not that they're failing a lot, but it has to do with crowd behavior. If you look at this chart right here, this was an example of Friday where the market kind of sold off under these overnight lows, I think, and then we're sort of catching a bid off of this level. So the market started to catch a bid, and then you can see clearly that there's a lot of buyers accumulating around this 209 to 213 zone. All right, now take a look at how the sellers start to answer at this point, and you're going to notice that the market's starting to have a hard time getting above here. 215, and then you notice right away the sellers attack it and we're down like 10 handles immediately. So often when I see things like this, you can see that obvious hammer candlestick, okay? Normally when the market does this, again, it doesn't mean this is going to work in the future, but normally when the market has done this, meaning bounce aggressively from a level and come right back, either up or down, normally it comes back to test it. So look, in this case, you're going to see once we failed, those sellers attacked it, and then we easily came back to trade under 200 in a short amount of time here. So look at our buyers trying to bounce it back to 210, 212. It's looking for a bid, but again, it's having a hard time. So it's trying for it. It's trying for the 211, and it just can't quite do it. And you can see that we're slowly fading our way back down there. And then sooner or later, we're starting to trade a little lower here. And let's see if we manage to crack that low. So there we go, right through the low. And I guess anybody who bought this, stop right under the low, you got taken out right there. And then at this point, you're seeing the same sort of thing. Look at that. So we took it out by a couple of ticks and we're bouncing right again. So again, if the seller's still there, this is going to set up a good opportunity to do the same thing twice, essentially. So again, right there, we bounced it, caught some buyers on board, and then boom, we're going down to take out the lows another time here. That was just me sort of narrating this in a way that could kind of simplify it for you. I'm not saying that this is going to work for you. It's just a way of analyzing order flow and price patterns. So again, we're talking about liquidity traps, and basically in relationship to cliche candlestick pattern ideas. So again, I'll say it, basically it's the hammer pattern and the engulfing pattern. Those things basically, if they're not being supported by things like one-time framing, then you should probably fade it. So for example, if you're seeing one-time framing down, so which meaning that we're seeing lower closes on every candle, and we're never seeing a higher close, but you see something like a bullish engulfing candlestick, that might be a good opportunity to jump on board the bear trend. Anyhow, so all of this might be kind of confusing to you right now if you don't have any knowledge about tape reading or market profile. Here's another great example of a liquidity trap. Okay, so let's take a look at some of this price action. Okay, so take a look at this. You can see that the market continued to sell off, and now we're starting to see this idea show up again, where the market is sort of giving the idea to participants that there is some support here around this 160 zone. All right, so if you look at that, the first time we traded down there, we probably bounced very aggressively. So right there, we traded down to the low 60s and then we bounced right up to 78, 80. All right, so that's giving the impression to participants that there is some demand at this price. Now, from that information alone, we can say, yes, there's probably some demand here. So we need to continue watching. Now you can see that there's a lot of contracts being accumulated into 79.50 there. And then we continue to watch. All right, so that's test number one. Now let's fast forward a bit. You can see we came down to test it, but we didn't really test the lows. So fast forward a little here. Now look at this. We came down, took out the low by a few ticks, and then we got the same old story. All right, so let's watch that together. Come down, take out the lows, aggressive sellers, and then we immediately bounce right back up about 10 handles from that low. And then now buyers are looking like they're in control. Okay, so this kind of stuff right here, it's giving the impression to a lot of traders that it's time to buy the market, okay? So this is a form of deception that can be created by market specialists because remember, they have a lot of tools. They can pull the bids and the offers any which way they want. So if they want to make the market look strong, they can do it. All right, so look at that. We have this nice double bottom setting up here, but where are we rallying back up to? This 80 zone where the offer, at this point hasn't lifted at all. I'll fast forward 30 seconds and you can see that the thing just tanks right through it. And there was no real support there. So that's an example of a clear liquidity trap. Once bounce it and then again give the idea to participants that there is some demand at those prices, but in reality it's just the seller has not lifted from that 80 to 82 zone and now we're seeing lower prices. So again, we saw another great example right there. If I go back down 10 seconds, we traded under 1150 and now you can see the market is accumulating some size. Now take a look here and we bounce right back up to 60, and again look at the candlestick pattern and you can see that it's formed a hammer. And watch 60 here. Remember, this is exactly where we just finished selling off from, where the traders thought that there was some potential support. So watch 60, we bounced from under 50 and now watch how the sellers come right back and we're trading right back to 50. So that was a great example of a fade right from this level that we had initially failed. All right, guys, so there's a couple of examples. Now, that's an example of a shorter term liquidity trap, but again, these things happen on larger term time frames as well, okay? Let's fast forward this session and we're gonna take a look at how this pattern set up. So you can see that the market started to catch a bid, and then we saw this sort of thing where the market started to find some demand finally. We sold off aggressively right to the point where the market is kind of finding some real demand. So you can see at this point, we have aggressive sellers entering the market. Where does it stop? Right around this 33 to 40 zone. And again, that's where the real support was, because that's the point where the price just wouldn't go below. I won't be able to categorize it for you in this video as to what categorizes as real support versus fake support. And again, that's going to be relating to how you filter out your levels to make sure you have the right ones, not the wrong ones. Okay, so our sellers managed to take control and we find ourselves back at this 160 zone. So now at this point, just by looking at this chart, you can tell that there is long interest, right? So once, twice, 3 times, 4 times, and now here again. So, when we have that many sort of obvious candlesticks indicating that there's long interest in the market, it increases the probability, at least from my perspective, that we can at least take out these lows here, okay? So take a look at how the sellers interact. I'll fast forward it a little bit. We see a bit of a rally, but again, each rally is getting sold. We're getting more obvious candlesticks. And again, this is just contributing to this larger liquidity trap here. And what happens is we eventually just smash through those lows. All right, guys, so that's going to cover liquidity traps in this video. I just wanted to kind of make you aware that this is one way that market specialists use to confuse traders into getting into the wrong positions. So if you want to stop getting into the wrong positions, you need to make sure you're filtering out your levels and your biases correctly, which again is not an easy task to perform. All right, guys, so I will see you in the next video. Hope you enjoyed the content. Take care. Bye.